Forward Guidance is brought to you by VanEck, a global leader in asset management since 1955. You'll be hearing more about a VanEck ETF later on, but for now, let's get into today's interview. We have mayhem in the markets and maybe in the economy. I am recording on the morning of Friday, August 2nd, and the jobs market came in with some pretty big news. There was a nonlinear jump in the unemployment rate from 4.1% to 4.3%. Unemployment now stands at 7.2 million, up 352,000 for July. Non-farm payroll gains were only 114,000. The SOM rule has been triggered, that recession trigger, and now the short-term interest rate market is pricing in a 65% chance that the Fed will cut in September, not 25 basis points, a single cut, but that it will do a double cut. The stock market, S&P is down 1.6%. As we record, the NASDAQ is down 2.2%. And I am so glad to be joined by Mike Green, Chief Strategist at Simplify Asset Management, PM of the FIG ETF, and author of the Yes, I Give a Fig Substack. Mike, great to see you. What are your thoughts? We've got a lot to talk about.
This has been a frustrating one, to say the least, because the economic data really couldn't have been clearer if you actually understood what you were looking for, rather than trying to justify where the S&P was going. And so this is one of these great ironies, right? We understand that the S&P 500 is supposed to be a leading economic index. It's supposed to be one of the factors that contributes to a forward-looking insight, and it's increasingly relied upon by policymakers. Same thing would be true for things like credit spreads, et cetera, market-derived measures of economic activity and risk in the economy, often playing into what are called financial conditions. The problem is that when you create a data dependence and you create a data-dependent Fed that says, we're going to look at the data that's coming out, you are presuming that that data is actually giving you information that is valid. And unfortunately, what's happened over the last really over the last decade, is that the data sets have been increasingly manipulated to try to reflect a smoothing of the economy. The most obvious one of these is the birth-death adjustment, which continues to suggest, even as private sector jobs are very clearly actually contracting at this point, that the contribution from new businesses being formed is in the neighborhood of about 1.25 million new jobs created by new business formation on a net basis in the last year. Unfortunately, we have data that allows us to check that and run against that. Things like the quarterly census unemployment and wages and the business employment dynamics analysis. Those come out with a lag, but we already know that they're telling us the data we received last year was horrifically inaccurate.
Meaning it showed that the labor market was stronger or less weak than it actually was.
Significantly less weak. So somewhere in the neighborhood of 60 to 70% of all jobs that were created in the last year were created in a fictitious birth-death model, right? This is a model that was modified in 2012 and again in 2020 to try to give a quote-unquote smoother view of the economy, try to incorporate or reduce revisions to the data sets, which historically had been to the top side. The government had traditionally under forecasted how many jobs were introduced. Now, I would argue that that's actually a feature, not a bug. If you are overly cautious in your expectations, you're more likely to behave in supportive manners of the economy. We've now flipped that around, and for over a year, we've had data that suggested that the economy was strong, that inflation was persistent. That's encouraged the Fed to keep rates at a very high level that is candidly just raising the costs of the ultimate financial distress and reducing our ability to work our way through this. We've seen the weaker segments of the economy, the commercial real estate, auto sales, housing markets, for example, have weakened markedly. We just are pretending that like there's no interest rate sensitivity to the economy, when what we really have is a bifurcated economy. Those who need to borrow, those who are in expansion and new acquisition mode, we can call those people young people, for example, right? I want to buy a house so I can move on with my life and start planning for the next stage. If I'm not able to do that, it retards household development. It means I'm going to have fewer children over the lifetime of my marriage, or I may even choose not to get married, right? And so all of these things have meaningful consequences for the longer term health and productivity of the economy. And we've completely ignored it because of these modifications that were made in the name of smoothing the underlying data sets. That in turn feeds into things like, well, let's try to explain the S&P 500. The economy couldn't nearly be as weak as everybody seems to be saying it is, whereas survey data or unmodified measures of unemployment suggest it can't be that weak. Just look at the market, right? And the most recent one, of course, was the Russell 2000 breaking higher, small caps breaking higher, and a sign that the market is broadening. Unfortunately, this is where my work around passive just suggests that nothing of the sort has happened, right? And so we've now been led down a path that says everything's hunky-dory when the reality is that floorboards are extremely rotten.
I want to get your views on the stock market and passive in a moment, but just do you think that we're in a recession now? And if not, do you think we're headed to one imminently?
Yeah, I think revisions will ultimately tell us that we are almost certainly in a recession that probably started in the fourth quarter of 2023.
Wow. So why has the stock market been going up? Explain briefly for our audience what is passive investing and the impacts that it's had on the market, and has it been driving this market higher beyond what you perceive to be the fundamentals? What gravity should dictate based on how weak you think the economy's been?
Sure. So I think all of your listeners know, quote unquote, what passive investing at least is suggested to be. It's the purchase of broad market indices in an attempt to participate in the stock market or in the bond market as compared to try to select securities and allocate capital on the basis of some sort of fundamental or technical insight. Those theories gained credence in the 1950s and 1960s around the growth of what's called the efficient market hypothesis, which posited that since all of the stocks together reflected all of the underlying opinions, that ultimately an information-based model of the market would incentivize people to go out and create new information and insight and understanding around businesses, and that prices ultimately had to reflect the best available information at that point, right? That's what's referred to as the efficient market hypothesis, that the market is going to be more accurate than any one forecast. On the back of that became very clear analysis, right, or thought experiments that said, well, if that's the case, then ultimately somebody who simply buys the market is going to reflect the best of that available information at any point in time without necessarily having to incur the costs associated with that research or pay the fees that are demanded by active managers in exchange for the research and insights associated with that. Since the aggregate of the two has to be the same under this thought experiment, simply capturing lower fees, for example, in a Vanguard type fund, would create outperformance over time. And that has underpinned both the theoretical and the actual realized, the empirical growth of entities like Vanguard and passive index-based investing over the past, give or take, 50 years at this point. First funds were introduced in 1974 into the institutional space. I believe John Bogle first launched his fund in 1975, right? First into the retail space. So for the past 50 years, this has been an undercurrent in the market, is this growth of passive investing. The reason that I criticize this is that there's another component to quote unquote passive investing, which is the presumption that the passive investor is truly passive, meaning they're not influencing market prices. And that's actually a component that is built into and relies upon effectively the axioms of the efficient market hypothesis, one of which is that markets are highly elastic. Right? Now, this is the economic term that refers to how much does price change in response to changes in supply and demand. A highly elastic market is one in which there are many substitutes, right? A really simple example is, do I need to own Delta Airlines or can I own United Airlines as a substitute? Those two are largely interchangeable. So as an active manager, if I have insights that the economy is strengthening, I can buy Delta Airlines. And if Delta Airlines goes up too much, then I can buy United Airlines. I can create sort of an arbitrage type regime in which I'm buying my underlying insights at the lowest possible cost.
And Mike, so it's the audience that, let's say in 1990, you buy Delta and I buy United, and 30 years later, Delta is profitable and is, you're up 50 times, 20 times on your investment, whereas my thing went bankrupt. Over time, the stock selection will really matter because some companies like Nvidia do incredibly well and some do horribly, some go bankrupt. But on any given Tuesday or Wednesday, if Delta's up 2%, United is probably going to get 2%. And they trade very, very correlated unless, Delta reported earnings and it was amazing and United reported horrible earnings and then you have a divergence. But as any given move on a day, it's just going to be airplane beta.
Yeah, effectively, yes. And so that is one of the insights associated with it. And as long as that's true, ultimately the market should be able to absorb with relatively little impact the insights of any one investor. All right, so that's part one. The second part in this is the presumption ultimately that other people are not only doing the work, but ultimately profiting from it. Right. And so that creates an incentive for people to go out and gather the information, do the work, allocate capital on a differential basis, and their efforts ultimately benefit the group as well as the individual. Right. Others are less fortunate, choose terrible managers. Their performance deteriorates, and theoretically, they should be switching either to passive, to a neutral type investor, or they should be finding and identifying good managers, raising the quality of game. That's the underlying theory behind how it's supposed to work. The problem, of course, is that the definition of passive that allows that to actually occur is one that was articulated in 1991 by Bill Sharp, who won the Nobel Prize in economics for his work around market pricing components. He's the inventor of the Sharpe ratio. His assumption is that passive investors are defined as passive because they never transact, right? They never transact. Now, of course, that becomes completely absurd in an environment in which Vanguard is receiving inflows every 2 weeks from your paycheck, and passive has gone from roughly 1% market share in 1992 when Bill Sharp, 1991, when Bill Sharp is writing his paper around the arithmetic of active management, to today, around 40% of the assets in the market are passively indexed in the United States equity markets, right? To assume that that model holds through that process is completely absurd. And unfortunately, the empirical evidence is increasingly moving in the direction of my theories, which say that the role of passive is actually becoming the dominant player in the market, that the elasticity in the market is actually extraordinarily low. And that's particularly true in an environment in which people have to buy stocks in proportion to their representation in the index. So if Microsoft goes up 10%, I can't substitute Oracle for Microsoft. Otherwise, I expose myself to fiduciary liability. I have to chase Microsoft. And by the way, I don't care because I have no insights whatsoever into whether Microsoft is rich or cheap at 31 times earnings. What I do know is if the price of Microsoft, the market cap of Microsoft goes up, I have to buy more of Microsoft in line with the index.
For new inflows, for someone who's already allocated and is the Bill Sharp idea of they've put their money away and they're not taking money out, they're not putting money in, the weighting will change as Microsoft goes up more than other companies. But for new inflows, you have to buy more A+.
And that's really the key flaw in the theory, right? If you could indeed magically hold every security as Bill Sharp posited in 1991, then you would have relatively limited impact on the market. But when you are receiving inflows into entities like Vanguard or BlackRock that exceed $300 to $400 billion a year, and meanwhile active managers are being redeemed to something along those same lines, you actually create a very perverse dynamic in the flows in which the passive components, which rewards size, large size, it rewards momentum, right? It rewards things that are richly valued. And the redemptions coming from the active management space where people tend to seek out value or they tend to seek out forward opportunities as compared to something that has happened in the past, those actually get net sold. And so the system actually behaves the exact opposite of what you would have expected it to do under the historic framework. And unfortunately, that's really what the empirical data suggests is happening.
And so how has this phenomenon of passive investing over the past year, or we might even say year and a half, let's start at the bottom of the market in October, whatever day it was, 2022. Things were looking a little bleak. How has passive investing fueled that rally we've had from October 2022 to now?
So there's a couple of things that I think are actually quite helpful if we're looking within that framework. One of which is actually to address what happened in 2022. So I just want to highlight this for people here. So this is actually looking at what happened in 2022. This was an academic paper written by Zhu Lu, who was a PhD candidate at Stanford. She's now, I believe, at the University of Washington. And this is an extension of some work that was done by Jonathan Parker at MIT in 2020, as well as work by Hannah Lustig at Stanford in 2012, right? You do not need to remember any of this stuff. The really key observation that they made is that increasingly portfolios are taking on fixed construction components, right? So I decide to run a 60-40 portfolio. If I'm in a target date fund, it is a fixed allocation that has no inputs whatsoever associated with valuation or the level of yields in bonds. Instead, it presumes that there's an endogenous return and risk profile for each asset, where the only selection methodology should be a function of how old I am, right? So the only thing that changes allocations in target date funds is how old I am.
Because young people can take more risk because they have more time. So they should, a 20-year-old really shouldn't own any bonds whatsoever. And if you're 80, you got to be in, you got to have some cash in the bank. So don't pile into a triple NVIDIA levered long fund.
Yeah, I think there's some of that. I also think, though, that it's really important for people to actually understand that part of what's actually going on there is a function of the contributions, right? So if I start out at my first job and I'm 22 years old and I am entered into a 401k plan, over the course of that year, the asset growth in that 401k portfolio has almost nothing to do with market performance. It has almost everything to do with my contributions and the employer match. But so this is actually one of the great ironies, is that the younger people, as they begin to save in these programs, are actually in many ways woefully under-risked and underexposed to the behavior of the market. They're very exposed to the question, do I have a job? Right? Yeah. The older generation then actually has a very different scenario where their contributions become increasingly less relevant to the balance, and they become more and more exposed to the market volatility. And this is one of many reasons why ultimately you should see the share of equities in portfolios decline over time. It's not a function of return expectations or even your capacity to be in the market, as much as it is that you naturally are increasing exposure as your contributions become smaller and smaller relative to your underlying balance.
Okay. So I get that, a 20-year-old, they don't have any money squirreled away. And as soon as they get their job, they're allocating to their 401k and they get an employer match. So, they have zero saved, and their first allocation to their 401k, let's say it's $500, that and their employer 100% match is $1,000 in total. 100% of their thing is from an inflow, whereas a 70-year-old, they've got a nest egg, and if they're allocating to it, that's only a tiny fraction of it. I understand that, but how does the percentage of allocation not depend on age? How is it not true that 80-year-olds, should have a lot more cash as a percentage of their assets than 20-year-olds?
So first of all, I just want to be clear. I don't actually think the argument should be around cash. It should be around the ultimate volatility of the asset, right? So let's take exactly the example you just gave. 22-year-old, $500 contribution with $500 match from their employer. The very first month that goes in is exposed to 11 months of volatility from equities. Let's say they went 100% into equities over the course of that year. Equities on average are going to deliver somewhere in the neighborhood of 15% volatility, right? They're capturing 11/12 of that, right? So you can do the math very quickly on that. $1,000 achieves X amount of volatility. The next month that comes in gets 10/12 of that volatility. The next month that comes in gets 9/12 of that volatility, et cetera. And so by the time you get to the end of that year, I can tell you with almost zero question, no matter how much you allocate to equities, what your balance is going to be, because the vast majority of the contribution was never actually in the market for a meaningful enough time to be exposed to any real change. Your balance in that portfolio is going to be very close to $12,000 at the end of the year. I don't care what the market did. Maybe it'll be 14, maybe it'll be 11, right?
The median dollar was allocated in the 6th month. And
right. So there's very little volatility in that portfolio, which is actually ironic, because people correctly point out that younger person should be seeking volatility. They should be seeking lottery-like payoffs associated with it. And this has led people to do things like Bitcoin, crypto, et cetera. They're looking for that way to add volatility to their portfolios. On the flip side of the equation, you become overly complacent as you dollar cost average in as an older investor, where your contributions feel like they're meaningful to you, right? I'm dollar cost averaging into the S&P 500, but the reality is that the volatility of your portfolio is completely subsuming those contributions. Does it help? Does it reduce the volatility? Absolutely, right? But is it enough to offset the volatility exposure that you ultimately have? No. Now that then brings us to the second. So I'm not arguing that people do not naturally want to move more towards fixed income as they get older, but I'm actually pointing out that most of the behaviors that we see are people doing the exact opposite, right? People are seeking more and more equity risk. And in order to compete, things like target date funds have increased their equity allocations over time relative to what they were 10 years ago, right? So there's more and more risk seeking to it. But let's go back to the chart that I was sharing, which was looking at the why we went down in 2022, right? So this is actually a novel way of thinking about markets, which is what if people are increasingly exposed to fixed portfolio allocations, things like target date funds? If I'm running a bond fund and the Federal Reserve hikes interest rates to a significant degree, what's going to happen to my bond portfolio? It's going to go down, right? Just mechanically, it has to go down because it's subject to arbitrage constraints tied to the cash flow components. If my bond portfolio goes down and I'm running a aggregate portfolio that is bonds and equities, let's just say it's 50-50 to make my life simple. My bond portfolio goes down. What do I have to do? Bonds are now underweight my portfolio. I have to sell equities and buy bonds. All right. Every time the Fed hikes rates, sell equities, buy bonds. Now I can tell myself that that's because I'm doing some discounted cash flow analysis. I've recalculated the weighted average cost of capital of the companies in my portfolio, and I'm reallocating that. But the simple reality is none of that is true. Right? We actually know that's not true for the vast majority of investors. They wouldn't even know where to begin in calculating a DCF. And so if we actually look at what happens in 2022, we see exactly this payout function.
Right. There's a positive correlation between stocks and bonds. As bonds sold off, stocks sold off, which for, pretty much my entire lifetime, there's been a negative correlation. Bonds are supposed to be a hedge for stocks, which incidentally is what happened today. There's a growth scare in the market, stocks sell off, and bonds have rallied tremendously.
Yeah, so I just want to distinguish though, because those are slightly different. The correlation between bonds and equities on the sort of daily basis that you're referring to, right, which is what you're capturing when you look at that correlation chart, that's actually slightly different. That is actually capturing effectively why the Fed is engaged in interest rate policy. Anytime the Fed is interested in fighting inflation, you're going to see the relationship that we've seen over the last couple of years. You'll see negative correlation between yields and bond prices. Super simple. What the Fed is effectively trying to do is choke off growth. That means that if you have growth expectations going up, which theoretically should be helping equities, bonds should be falling, causing yields to rise, and in turn, an expectation that you're going to see this play out in the equity portfolio as well. The minute we flip back to, as we're seeing today, growth scares, and that the Fed is going to intervene on the side of propping up growth as compared to worrying about inflation, we'll go back to the negative correlation in terms of higher interest rates are associated with higher equity prices. So today is just telling you this is one of the first real growth scares that suggests that the economy is shifting fairly aggressively towards the Fed targeting a very different model of why they should engage in monetary policy.
Right. So how did passive investing drive the rally from the lows of October 2022 to now?
What happened in October 2022? The Fed slowed its pace of interest rate hikes dramatically. Right, we actually saw the interest rate sensitivity of the bond market deteriorate because, among other things, the duration of the market ultimately began to fall. And if you look at that chart that I had put up, the portfolio rebalance channel, right, this is this idea that you have a fixed allocation. You can literally see this behavior not on a daily basis, but actually on a cycle of the Fed hiking rates. right? So equities versus bonds, this is looking at the total equity market index versus bonds. Every time the Fed would cut rates, you'd actually see, or hike rates, I'm sorry, you would see equities outperform, followed by equities being sold, bonds bought, etc. This continued until October of 2022, at which point the market was able to start to run away again. That sensitivity was gone. It actually really continued until basically the Silicon Valley events of early 2023, which began the process of cutting the end, putting the end on the Fed hiking cycle, right? So the reason I'm highlighting this is that this is just saying there is not thought behind this. It's not like somebody's actually turning around and saying, gosh, interest rates are higher. If you remember going into 2021 and 2022, the argument was, well, technology stocks are leading because interest rates are so low, and therefore the discounted cash flow calculation of their forward growth is going to, is capturing so much more, right? Well, what happened to valuations after that cycle, right? After we've now hiked interest rates to the highest levels that they've been in, give or take 20 years, we still have high valuations and the market is still being led by technology stocks. So there's something flawed in that model that people have been using around why were valuations high, because interest rates had no impact on it.
So correlations between stocks and bonds should on the margin be more positive than traditional portfolio theory suggests, because if so many people are allocated into a 60-40 fund, or let's just say a 50-50 fund, as the value of their bonds goes down, they have to sell their stocks too and allocate more to bonds. And then as bonds go up, they have to allocate more to stocks. Of course, as stocks go up, they have to allocate more to bonds.
Yeah, and so I think all of those things ultimately play through this portfolio rebalance channel becoming more important over time. There is another component to it, though, which is remember that new entrants into the labor force, almost by definition, are young. In a target date type framework, they're basically 100% allocated to equities, so your marginal contribution is very favorable to equities. Your older generation is starting to transition away from equities and into bonds, but that's happening at a very slow pace. And until really the past couple of years, we didn't have a lot of old people who own significant quantities of passive strategies or were exposed to things like target date fund methodology simply because they didn't exist when they started investing, right? People forget that target date funds didn't really exist prior to 2003. So these are all relatively new innovations that have grown remarkably. Target date funds are significantly larger than hedge funds, for example, now. Right? These are asset component. These are components of asset markets that nobody's really been paying attention to, and kind of operating under the theme, the underlying theme that, well, they're passive. They can't be influencing the market, and so that's created an incredible search for, who can I blame? Right? Must be the Federal Reserve. The Federal Reserve must be the bad guy. The Fed, needs to cut interest rates more aggressively. Oh my gosh, people are continuing to speculate in technology stocks and crypto. The Fed should hike even more aggressively. Meanwhile, as we've seen in the past couple of days, the economy has slowed dramatically. People are starting to lose their jobs. And the great irony, unfortunately, is that as people begin to lose their jobs, those underlying flows into the stock market that have been propping it and pushing it higher begin to deteriorate. And then we have a situation in our hands where we just don't know who the natural buyer at anywhere near these valuations is.
Forward Guidance is brought to you by VanEck. The VanEck Morningstar Wide Moat ETF, ticker MOAT, has outperformed the S&P 500 for over a decade. How? Moat strives to achieve a simple but challenging task: buy quality stocks when they're undervalued and sell them when they're overvalued. Visit vaneck.com/moatfg to learn more. That's vaneck.com/moatfg. Now the disclosures. All investing is subject to risk, including the possible loss of money you invest. Visit vaneck.com to carefully read a prospectus before investing. The VanEck Morningstar Wide Moat ETF is distributed by VanEck Securities Corporation, a wholly owned subsidiary of VanEck Associates Corporation. Thanks. Let's get back to the interview. So I totally accept your critique that I think a lot of people focus literally everything on the Federal Reserve. Oh, there's some crypto has gone up so much, the Fed needs to, hike interest rates again. I might turn it back on you, Micah, and say, are you being too reliant on passive investing? For example, like if Apple, I'm looking at Apple versus IBM. In 2011, they both had the same revenues of $100 billion for the trailing 12 months. Now Apple has revenues of close to almost $400 billion every year. And IBM it's shrunk to 62 billion. So, Apple has crushed it in the market. The stock has gone up so much, and IBM has languished. I look at that and I say fundamentals have worked. You say, oh, it's only because Apple is a large percentage of the S&P, and it's passive inflows that are distorting the market. Where's the distortion?
Actually, I don't think that's true at all. I just want to be very, very clear. The dynamics of passive can reinforce those types of components. And importantly, Apple is very engaged in another behavior that under a passive framework, or more accurately, what's called an inelastic market framework, where stocks do not have easy substitutes and stocks are not capable of being easily substituted for each other, right? So Apple versus IBM. Apple has been one of the largest participants in stock share buybacks. And so my challenge to you would actually be not about the fundamental performance or even the fact that Apple outperformed, but the fact that Apple's valuation has risen dramatically from the point that it was $100 billion in revenue to $400 billion in revenue. Its multiples have increased. It's actually become more richly valued and has higher growth expectations as it's become even larger and captured a larger and larger share of the consumer wallet. That's in direct contrast to what we would expect under the law of large numbers, where the growth is ultimately limited by the aggregate growth of the economy and the consumer basket. Apple has definitely taken share, and that's definitely helped. But the simple reality is under that framework, you should have seen multiples contract over time, not rise over time.
Well, people have been saying that Apple can only grow so much because it can only be, you can't get bigger than the entire economy. And of course, that is true. But Apple and Microsoft and a lot of what is called Magnificent Seven, definitely not all, but a lot have continued to grow and grow way more than the economy. Apple, it's trading at a PE of forward expectations of 18. And you could say that the forward expectations that they're earn too much. I mean, typically analysts actually like to sandbag them so that they can outperform and then the stock goes up. But some stocks in this market are absolutely ridiculously expensive. I mean, I look at Chipotle, a PE of 50 for chicken. It's a little much to me. Nvidia, I actually think is cheaper than Chipotle. But unlike Chipotle, Nvidia is growing its revenues at hundreds of percentages year over year. You don't think that the growth in market cap of the Microsoft, Apple, Nvidia it's not merited by their remarkable growth in revenues and profits? How much percentage of do you think is fundamentals versus what percentage is passive and flows?
So on the valuation front, the aggregate valuation in my models of the entire stock market, and I just want to be very clear that, again, passive has a limited role in the ranking of companies. It has a significant role in effectively pushing the largest companies to higher valuations relative to the smaller companies, right?
So how does that wait? But how could you impact the valuations of the higher companies relative to the lower, smaller companies without impacting the ranking?
Because by definition, if they're already the larger companies, they're just being pushed further apart, right? It's saying the difference between first place and second place grows, not who is in first place or second place.
That makes sense.
Yeah, no, I mean, I know it makes sense. Yeah. I get how frustrating it is to people to think that this is, something that is truly, truly going on. I would just flip it around and also ask, how do you think valuations have expanded to the point that they have on many of these super large companies, particularly when we look at who the holder space is, right? So who is the largest holder of Apple?
Vanguard or Berkshire Hathaway? Probably Vanguard.
That's unquestionably Vanguard.
Yeah. Because you asked the question, I'm like, it's probably Vanguard.
No, all right. So what's the largest holder of the second largest company in the world? Microsoft.
Vanguard.
Okay. Who's the largest holder of the third largest company in the world?
Vanguard.
Who's the largest holder of the fourth largest company in the world?
Vanguard, and the second answer is probably BlackRock. Yeah. And then State Street. Yeah.
So I mean, and those. If we saw Warren Buffett buying shares in a company, we would anticipate that it would push the price higher, right? That's why people follow what Warren Buffett is doing, in part because they understand that his actions are going to influence the actions of other players. Why would we think that passive is any different?
Well, I think there are two things. Number one, Warren Buffett buying stock. Anyone who buys stock drives the price higher. There's also a thing of, the Oracle of Omaha is buying this, and then so there's the rumor and the gossip. So Vanguard doesn't have that. But yeah, definitely. I mean, buying something drives the price higher. That's a.
So I just want to point out, though, that is in direct violation of the theory of passive investing.
Mm-hmm.
So what you just said is that the theory under which passive receives protected access to the wallets of Americans is wrong.
Okay.
Right? I mean, does that seem like that might be a problem to you?
Yeah. What do you make of a company that is not a huge percent? Like, what do you make of Nvidia's rise? What percentage of that is passive versus fundamentals?
I got to be honest with you, I haven't done the math to say what percent of Nvidia per se, but it's very clear that Nvidia has been a beneficiary of an extraordinary improvement in its fundamentals.
Mm-hmm.
Right now, the question becomes how much of that increase in market capitalization and valuation was facilitated by the existence of investors who would never sell no matter what the valuation. And in fact, actually became a positive feedback loop, positive meaning reinforcing in this concept, not necessarily a good or a bad thing, in which higher prices and higher valuation for NVIDIA caused them to allocate more and more of their marginal portfolio purchases to NVIDIA itself. Right. NVIDIA is a great example. We actually just went through this 2 days ago. Right. I don't know what it's doing today because I'm on this interview. But if you look at what happened to the price of NVIDIA, it rose $350 billion, $325 billion in market capitalization. Under a traditional information-based framework, an EMH-based framework, you would have needed to see inflows somewhere around $350 billion in order to get NVIDIA to come anywhere close to that. In many ways, actually, it would have been significantly more than that because the models of the EMH say $1 in creates about a penny of market cap, right? So to get $350 billion, you would have needed to have somewhere in the neighborhood of $35 trillion of inflows in order to drive the price of NVIDIA to those levels, right? And everybody else would have received money on the other side. That's obviously absurd. It actually turns out that the inflows into NVIDIA that drove the vast majority of it because NVIDIA gapped up in the overnight hours, right? On a recommendation from Morgan Stanley that basically boiled down to Roaring Kitty saying, hey, I like the stock. Right, you saw a $225 billion overnight gain in market capitalization for NVIDIA on the back of, I believe the number was somewhere around. So I just wanted to orient people, the total transaction value over the course of the day, right? So this is all buying and selling activity of NVIDIA was somewhere in the neighborhood of $60 billion worth of notional trading. Right now, every buyer has a seller against it. And so that doesn't come anywhere close to measuring the net number. And again, in fact, what you actually saw was the vast majority of the money of the price change occurred in the overnight hours when a tiny fraction, right, about 5% of all that transaction activity occurred. Right. So NVIDIA had a $225 billion overnight market cap increase on what looks like about $5 billion worth of trading.
During overnight hours, so after the market's closed, and that makes sense, right? Because it's less liquid after hours, so less buying can drive the stock up more.
Absolutely correct. And so this is one of the reasons why we're seeing markets increasingly and individual stocks increasingly gap, is that trading happens after hours, right? Now, that's always existed to a certain extent, but what didn't exist is the largest individual investor stepping in and saying, oh, that makes sense, right? NVIDIA is now up 10% over hours. I'm not going to change my buying patterns ever, right? What price is the right price? Well, whatever the last price was. That's what passive is ultimately doing. It then prevents that price. If you just think about it in trading terms, the stock gaps up, and then traditionally you would see it fall off. Institutional investors would say, don't chase it. Let's wait for it to go down, et cetera. We've removed that don't chase it component. We've introduced a player into the universe who says, of course, that's now the right price. Whatever the market price is the best price, right? And if that becomes the largest player, it reinforces these dynamics and causes these valuations to continue to march up as long as inflows are occurring in passive. 2022, again, remember, you've created synthetic outflows. Even though people didn't really lose their jobs, even though the aggregate inflows were still positive, because the bond portion of the portfolios was hit so badly, people were forced to sell equities. And we saw a significantly terrible bear market without an accompanying recession in any way, shape, or form. It's very confusing for a lot of people.
Right. And of course, so many people watching this, as well as both of us, are aware of the fundamental reasons that people can say why the stock market was down. All these mega cap companies, they were spending money like crazy and their costs were up way more than their revenues were, year over year. The price of oil went to $120. You had 2 consecutive quarters of negative real growth. There was very high recession fear that did not materialize anywhere. But everyone, everyone talks about that all the time. What we're talking about, and I'm really glad that we're talking about it, is the flows that gets much less attention of this impact of, as the value of bonds go down, people have to allocate more to bonds and less to equity. So has the strong labor market, from October 2022 to now, the fact that the unemployment rate has been low, a lot of workers, a lot of people allocating to 401k, has that been the reason why the market's gone up so much?
It has been the primary reason why we have seen markets push higher, but there is an additional wrinkle to it, which is in the last 12 months, you actually saw people start playing along. And effectively, the way I describe it is say, oh, I'm in on the joke, right? So what works? Momentum, right? What stocks have been going up the most, right? That first through seventh player has been pulling away from the pack. Okay, how do I outperform? I'm going to allocate more to those largest players. That's caused the market to further consolidate around those few names, and the market itself has narrowed significantly. We've particularly seen this within the institutional investors like hedge funds themselves, who have gotten into the game of saying, well, obviously this is working. I'm going to buy the Mag 7 and I'm going to short the Russell 2000, which then on the cusp of the entire thing breaking down, and we saw the exact same behavior in 2021. I can pull up the chart to show it. You see the unwind of that trade power the Russell higher, convince people that the economy is broadening out, that the soldiers are going to take over the leadership from the generals. This is a positive development. We've heard all this language in the last 3 weeks, and it turns out to be a completely false dawn, because what you're actually watching is portfolios being unwound due to a change in risk characteristics.
So if there's a lot of people have a job, they're putting money into the market, and that's driving the market higher, and they're not caring about valuation whatsoever, that it can have a self-reinforcing prophecy where as the market goes higher, it continues to go higher. Does this work in reverse? Now that we've had a sell-off over the past few days, people are losing their minds, even though we're only, 5 or 6% below all-time highs. People are a lot more freaked out than perhaps they should be. But do you think this clock goes back in reverse, where, or tell us how, the opposite phenomenon? Now job growth has stalled, the unemployment rate is rising, and the stock market is going down. Does this go in the exact same way, but just in the opposite direction?
So unfortunately, that's what the math suggests, right? That this could be far worse than people would expect from a fundamental standpoint in the stock market, if we actually see the unemployment market turn and those flows turn negative. We have seen some really unique things. So, for example, the Vanguard, broad market indice flows have actually been flat to slightly negative for almost a year and a half now. That has been offset by, of course, the increasingly narrow inflows into things like technology, the mega caps, et cetera, as people played alongside that, as I indicated before. Now, of course, you could see that process work in reverse, actually tied to job loss, people not making contributions. And we're unfortunately seeing pretty strong evidence that some of that is starting to play through. What has happened in prior cycles is that because passive has gained so much market share as we've gone through this process, that we've almost never seen what it looks like for passive to sell. The few instances where we have seen passive selling have been really catastrophic market events, right? March 2020 would be a good example. August 2015 would be another example. A few days around Lehman Brothers in 2008, there was net selling coming from passive portfolios. But I just want to remind people that we really haven't actually seen this on a sustained basis Vanguard released a self-congratulatory note in April of 2020 saying less than 1% of our clients even tried to sell in the events around COVID, right? So the idea that there's going to be a discretionary move and suddenly people are going to panic and reverse, I'm a little skeptical on that. But I do think that we are unfortunately getting to this point where the aggregate flows could turn negative. And then we're going to be sitting there scratching our heads going, well, my gosh, why won't the stock market go up? How could we possibly get the stock market to go up? Right. And it'll be because the flows are moving in the opposite direction.
So the net flows are the result of gross inflows minus gross outflows. I understand that if as unemployment rate rises and fewer people are getting a job and more people are being laid off, that the inflows will slow to a trickle. But tell me about the outflows. Under what circumstances would a passive investor withdraw from the market? Why would they sell Apple and Microsoft and these things?
So again, 2022 is our guidebook, right? Because we actually saw a scenario in which they did do some selling associated with those assets because the bond portfolio portion fell so much. Mm-hmm. Same thing would be true once they're past retirement age and they start taking distributions. They are going to reduce their equity allocations to Apple, to Microsoft, et cetera, as they age and they consume their underlying assets, right? So this is kind of the worst case scenario for the baby boomers. They step into actually liquidating their portfolios, assuming that the level of wealth that they have accumulated is consistent with what their balance sheets actually show. And they discover that the price sensitivity of the assets that they own is far greater than they had anticipated as they go to sell them. That in turn raises the attractiveness of things like fixed income, which return a significant fraction of your capital, not through speculation and other people buying, but through the maturation of bonds and the interest payments associated with it.
Right, but when you get the opposite of 2022, where if we have a recession and joblessness spikes, that bonds will rally, and therefore people need to allocate out of bonds into stocks.
Yes, I think that's true. Again, it depends on the age profile in which you as an individual investor are existing. If that bond rally is not enough to offset the underlying need to increase the bond allocation in your portfolio as you age, then you will not see it work out that way, but it does absolutely contribute, right? And so part of what I think people should be aware of is that this system can actually work the opposite of what happened in 2022. As interest rates are cut, it's going to encourage you to sell bonds, buy equities at multiple points in this juncture. That's going to be very interesting from two fronts. One is it would be a validation of the portfolio rebalance channel. The second component, though, is just that it would actually suggest equity strength in a time period that you should actually be seeing more extreme equity weakness.
Yeah, that's really interesting. Portfolio rebalancing channel, that is how quantitative easing works, is that quantitative easing bids up the prices of bonds, and therefore that should impact the rest of the economy. Maybe quantitative easing is more effective, as interest rate channel is less effective.
For asset prices, yes. Very little effect in terms of the underlying economy, though. Right. So again, this is all these things that people have debated, right? What's the impact of quantitative easing? Well, by raising the price of bonds, I am actually absolutely impacting the price of equities if I have a portfolio that is continually rebalanced on a systematic basis between the two.
Right.
And it doesn't actually matter what's happening to quantitative easing from the perspective of, is it stimulatory to the underlying economy? It absolutely will have an impact in a portfolio component. That's actually the very first paper on this subject by Jonathan Parker at MIT. It's called The Portfolio Rebalance Channel, the Case of Financial Innovation and Target Date Funds.
Hello, everyone. Permissionless 3 is coming to Salt Lake City on October 9th. The event for crypto natives is heading west, and we are bringing the biggest names in crypto together for an insane, can't-miss event. Hear from more than 200 industry titans, including Balaji, Mike Novogratz, and Dan Tapiero. The conversations at Permissionless will be covering the hottest themes in crypto, including modularity, restaking, the Bitcoin and Solana ecosystems, AI and crypto, rollups and L2s, institutional adoption, and of course, the November election that will be right around the corner. We couldn't be more excited about this event. Get your ticket today and make sure I get some bragging rights by using my code FG10 to get 10% off. That's FG10 stands for Forward Guidance. I want to see you there. Do it. It's going to be at one of the most beautiful places in the United States, and everyone's going to be there. Van Spencer's going to be there. Jim Bianco's going to be there. Jan VanEck's going to be there. So what are you waiting for? Get your tickets now by clicking the link in the description and use code FG10. Back to the episode. Right. So, Mike, I think some people who have, brushed with your theories on passive, they might come away with the conclusion that it actually, leads you to be bearish and that short the stock market because it's a giant Ponzi scheme. It's all going to Apple. But from my understanding of it, you actually have a bias to be long and long passive because passive works. And it's like, if it is a bubble, yeah, it works. But the downside is that there can be, so volatility is smooth on the way up, but there can be very, very violent corrections, such as the one that we saw in March 2020. Do I have that roughly right? And, how are you playing this? How do you, how might people watching this play this? Like, is this, are you saying this is a bearish phenomenon, or are you saying this is going to cause a cascade on the downside, but in the long run, the bubble will only inflate to greater heights?
So, I hate to welch on this underlying dynamic. Yes, you are correct. My ultimate belief system is as long as money continues to flow into passive, you will see valuations broadly continue to rise, right? Now, there will be economic cycles underneath that in which earnings expand more rapidly than valuations for periods of time. But the models that I've articulated of passive have by and large actually impacted markets the way I would have expected, which is continued outperformance by the largest companies, markets being pushed to all-time highs on the basis of an expansion of valuation. And at the same time that that's happening, the IPO market can't function and you can't get companies public, right? And this has absolutely been the underlying story, to the point that there was a tweet put out by Richie Handler of Jefferies the other day saying the IPO market is open. And my response was, what are you talking about? It's operating at a fraction of the level that it did in 1999 or even 1990 for that matter, when the US economy was a fraction of what it is today. The market capitalization of the equity markets were a fraction of what they are today.
Well, okay. I get the emails from SIFMA. Let me see if that's true. The IPO market, it's nowhere was it was to 2021, or I'll take your word for it, 1999. But I would say, Mike, those were bubbles. Yeah, it's back to normal. It's not in a bubble, frenetic. We're issuing crappy companies left and right for $1 billion every single day. It's not in the winter that it was in 2023, I would say. But I'm looking up the SIFMA data, so we'll see.
Let's actually go directly to the charts. It's always the best way to do it.
So yeah, total IPOs for the quarter, probably Q2, was 9.6 billion, so up 39% year over year. Highest quarterly issuance since 2021, but 17% lower than the 3-year pre-COVID average. So yeah, it's getting better. If all, I don't buy when people say the only thing that matters is rate of change, but if the only thing that matters is rate of change, then this is bullish, because it was super depressed and it's getting slightly better, but it's still low.
Yeah, if you pulled it up in a slightly different way, which was the forecast for what people had expected.
Yeah.
So that was the tweet that I actually put out. But here, let's pull that into the screen.
And I should also say, I know for the investment banks broadly, investment banking is good. I think a lot of that is in the issuance of bonds and the refinancing, particularly of loans that are taking advantage not of the high interest rates, but of the very narrow credit spreads. So yeah, I take your point that IPO issuance is definitely lower than the investment banks want. Definitely.
Well, it's not even just lower than investment banks want. I mean, to your point, you can see the recent pop in IPOs. Importantly, this data set excludes SPACs, right? So SPACs went absolutely bananas in 2020 and 2021. Part of what's so interesting about SPACs, and the reason why now, of course, they're being excluded, is because they themselves were a passive index arbitrage phenomenon. So this was one of the things, unfortunately, I predicted in advance. I have friends in the venture capital space that took extraordinary advantage of it.
Yep.
It is a very, very poorly understood story, but the simple math is that SPACs, by virtue of being cash entities, were not eligible for index inclusion prior to their making an operating acquisition. And then there was a really interesting wrinkle that it never mattered until 2020, which is if they made an operating acquisition that would clear them of the 85th percentile hurdle in the index, they became eligible for what was called fast track IPO inclusion, which meant that the passive players could be forced to buy in as soon as 5 days after they went public. Now, the rules of SPAC construction are that insiders, who are the sole source of shares, cannot sell for a minimum of 20 days based on performance characteristics if it has to exceed a certain price level. Well, if the world's largest players are being forced to buy in 5 days and the shares cannot be made available for a minimum of 20 days, what's going to happen to price?
It's going to pop.
It's going to pop. It's going to go absolutely bananas. And that's exactly what we saw. Now, again, the narrative machine kicked in and said, oh, the reason why SPACs are doing so well is because companies can, make forecast statements that they couldn't otherwise make under a S1 prospectus.
Yeah, they're not allowed to lie under the regular IPO, but they're allowed to lie. Forecast.
Yeah.
That is true, though. You're right. You may be right that it's not the thing that drove the price up, but it is true. The underlying thing.
Yeah, no, the underlying data is true, but that became the narrative, right? That these companies were able to make forecasts and explain their business models in ways that they traditionally couldn't through an S1 prospectus. Now, I'm sorry, but if you actually think the issue with why WeWork was able to get public through a SPAC as compared through a traditional S1 prospectus is because Adam Neumann wasn't promotional enough under the traditional S1 roadshow type model, you're beyond help, right? I don't even know where to begin on that type of belief system, right? But what we actually do have is we have the very clear evidence that the minute that Vanguard and BlackRock changed the regulatory environment or the index inclusion components around SPACs, shifting them out of this fast track IPO status framework, they ceased to work. And nobody is using them to go public anymore. And it doesn't matter whether that chart that I shared is inclusive of SPACs or exclusive of SPACs. They're irrelevant to the market again, right? And so little things like that are going to pop up. We're going to realize how these things are influencing it over and over and over again. One of my key criticisms is the failure to own that responsibility coming from the BlackRocks and Vanguards.
So, okay, that's really interesting. In the same way that you remember kind of the beginnings of things, I first, entered the financial media business around the time that WeWork pulled its IPO. And I think literally the reasoning that was given, it was obviously an excuse, was like the religious holidays. Like, oh, well, we're not getting this deal done because it's a religious holiday. And then it did later SPAC and it's, trading in the pennies, if it trades at all. And so many very speculative companies that were losing money, losing millions and millions of dollars per day went public. And it really is a shame what I think they did to investors. And, I followed that market quite closely. And, there were a few diamonds in the rough, but I would say, yeah, most companies are trading well below the $10 and many are bankrupt. I think also because they're very low float, especially when few SPAC holders actually get the new shares and instead they want to redeem for cash. Like a SPAC is literally a bond. The risky thing is the de-SPAC. And if during a bubble, everyone wants the de-SPAC, but during 2022, when the bubble pops, everyone wants cash, and then there are very few shares, and then you can have some very extreme squeezes. Grindr is an example of a squeeze, as is Pagaya, a fintech company. But I didn't know that. I didn't know that about the passive inclusion. But Mike, but these things never made it, with the exception of maybe one or two made them in the S&P. But we say they were included in passive vehicles. Is this the Russell 3000, Russell 2000?
So most of them would have been included in something like the Russell 2000 that doesn't have the profit characteristics of a S&P 500. So that's one of the things that actually protects investors in the S&P 500 is a degree of quality component to it. The flip side of that analysis, though, is that it really doesn't matter all that much. When you start talking about something like the Vanguard Total Market Index, it's going to capture all the stocks.
That's like the VTI thing.
Yeah. So this is by far the world's largest investment fund, Vanguard Total Market Index. Ticker is VTSMX. One of the things I point out to people is, if you were evaluating an active manager that came into your offices and said, here's how we construct our portfolio, right? We buy basically every stock. And you said, okay, well, what are your liquidity characteristics? And I said, well, we own every stock. Okay, how much cash do you hold? right? What would be a reasonable level for an active manager to hold as cash? A good model of that would be something like the world's largest actively managed fund, which is the Fidelity Contra Fund, right?
Higher
So
than zero. Higher than zero.
higher than zero, a lot higher than zero, right? So against $136 billion worth of market value, Fidelity Contra Fund currently carries about $1.5 billion in cash. That cash can be used to meet redemptions. It can be used to identify incremental investment opportunities, et cetera, et cetera, et cetera. So these are all things that are embedded in active management. Is thinking about how to manage your portfolio so that you can meet redemptions, you can buy things without having to sell things, et cetera. On the flip side of that, the Vanguard Total Market Index, which is again this world's largest passive fund, they are $1.2 trillion in assets. It's actually, there's a couple of share classes that aren't captured there. Against that $1.2 trillion in assets, how much cash would you guess that they're ultimately holding?
A tiny amount, maybe even zero.
Yeah, it's actually been negative recently because
So they're levered. They're levered with their bank that they're doing.
Yeah, they've been forced to use a line of credit to help them meet redemptions.
Wow. That's negative. That's crazy. That's crazy, Mike. Wow.
It really is, right? And so like any institutional investor in a rational framework would look at that underlying portfolio and say, like, this is completely absurd, right? It's actually completely absurd that you've constructed your portfolio in this way, in which you have, give or take, $700 billion, $70 billion worth of Apple, but you've got negative $20 million worth of cash. Like, nobody would allow that to happen from a risk management standpoint, except for the fact that these are the world's largest investment vehicles and they control the regulatory apparatus. It's perceived as the safe thing to do. I'm sorry, that's just not a rational way to think about it.
So it's not rational, but to be clear, you think things will only get more and more irrational because passive continues to outperform not specific active funds, such as, I looked up Fidelity Contra Fund. Since going back to 1990, 1989, Fidelity, the S&P passive is up 3,000%, and the Fidelity Contra is up 7,700%. But the median active fund, your average hedge fund, has underperformed the S&P 500. So BlackRock, Vanguard, they've got the back test to prove, hey, we're outperforming, and after fees, we're really outperforming. You think that this passive bubble will only get bigger, don't you?
The passive bubble will get bigger unless regulators or individuals step in and stop that process. Performance, which is perceived as the limiting factor, can't do it for exactly the reasons that you're articulating. BlackRock and Vanguard can point to historical performance and say, hey, our funds outperform, right? Now, this is, again, referring back to the Bill Sharp arithmetic of active management. Now, under the arithmetic of active management and the empirical data to support it, what we should actually see is as asset managers' fees fall, their underperformance relative to passive should decline. In fact, we've seen the exact opposite. So this is a real problem for the theories that ultimately passive is driving that outperformance down, for the very simple reason that it's enforced lower fees. And to be clear, I actually broadly support the arguments to say one of the key benefits of passive has been forcing management fees lower. I think there's some caveats around that, and we can discuss those as we go forward on a market structure framework. But I do think that's really important. But let me actually share with you a chart that explains kind of what ends up happening here. So this is proprietary research that I did, in which I went out and I asked active managers, and I said, look, you're a portfolio manager, you have 5% cash in your portfolio, you receive a new inflow or outflow. How are you likely to transact or respond to that inflow or outflow given valuation? Right now, the chart on the left is actually showing you the aggregated responses from these investors. And unsurprisingly, what you find is their marginal propensity to sell rises as valuations increase. So valuations on the x-axis, marginal propensity to either buy or sell on the y-axis. Your marginal propensity to sell rises as the valuations rise. On the flip side of the equation, your marginal propensity to buy falls as valuations rise, right? This should be totally unsurprising.
Right.
Makes perfect sense, fits within the logic of how we should behave. What was really surprising to me when I ran this analysis and did this research was actually the intersection of the two was almost exactly 50-50 at exactly the market's historical valuation levels. Why does that make sense? So the next part of the analysis is say, okay, let's build agents, let's give them these rough rules, and then let's randomly give them money or take money away and see how the market evolves. And what you actually find is a market that mean reverts around a traditional valuation.
And the y-axis is relative price to earnings. So that 1.0 is a 16 ratio. It's relative.
That's the easiest way to think about it, right?
Okay, yeah.
So what you see is markets that engage in mean reversion. This is why something like the Shiller PE, by the way, actually works or historically worked, because really all it's saying is that there's mean reversion, right?
Yes.
So when you have active managers, their behavior is one that enforces mean reversion. When I introduce passive players have a totally different rule set. Did you give me cash? If so, then buy. Did you ask for cash? If so, then sell.
And the higher the valuation, the more they'll buy because it's more expensive, so it's a greater share of the market.
So I'm actually not even going to that step. I'm simply reacting to the fact that if I give money to an active manager, they can choose to hold cash. But if I give money to a passive manager, they can't choose to hold cash. They have to deploy that capital regardless of valuations. The wrinkles that you're referring to actually reinforce those underlying components. But what we've done as you introduce more and more players with 100% marginal propensity to buy or sell, you shift the market off of that mean reversion and you create expanding valuations. Right? Mm-hmm. This is exactly what we've seen. Right? Now, there's a second wrinkle to it, which is if I then say what happens, and I'll show you one more chart here very quickly. The bigger the company, it turns out, this is academic research that just came out in 2021 from Valentin Haddad at UCLA, where he's looking at the market capitalization of the company and that elasticity measure that we were referring to before. How much does price change in response to a change in supply and demand? It actually turns out that the larger the company, the more sensitive it is to these flows, right? There's two reasons for that. One is the companies become less substitutable. If I decide I'm going to build a statistically sampled version of the S&P 500, I can choose to substitute Delta Airlines for United Airlines, but I can't substitute NVIDIA for Microsoft. I have to buy them both, right? I have no option available to me. The second thing that happens is a function of the market making capability and the way that market makers operate. Turns out that liquidity does not scale with market cap. It scales with a combination of what it really works out to the profitability of market making operations. How wide is the bid-ask spread and what is the volume associated with the actual trading activity? With one more addition to it, which is how volatile is it, right? Because volatility turns out to be a drag on that portfolio's performance. So when you actually recognize this, what you recognize is that liquidity does not scale with market capitalization. And as a result, the liquidity for Microsoft is maybe 5 to 10 times that of companies that it's 100 times larger than, right? That lowers the elasticity of Microsoft and causes it to become more and more sensitive. I'm going to share with you some charts that haven't actually made it out into the wild yet as I talk about exactly this issue. Okay, so now, given those stylized facts that actually broadly, and here, let's just take a look at the empirical data behind it. So remember that the assumption in how markets work under things like the CAPM formula is that there's an endogenous return to the asset class with mean reversion around it based on a combination of economic activity, flows, new issuance, all sorts of things that valuation certainly should contribute there, et cetera, that cause there to be kind of a central tendency with mean reverting characteristics. But as I just showed, markets have become increasingly non-mean reverting. Right. So what ends up happening here is it turns out that alpha. So I just realized that's the wrong screen I'm clicking on. Turns out that alpha is actually a function of the easiest way to think about what alpha actually is over time. It's just a y equals mx plus b equation, right? The return of your portfolio is equal to the beta of the portfolio
Mhm.
times the market plus some idiosyncratic intercept we call alpha, right? If I take a curved surface, remember that valuations have now become mean expansionary. That's pushing valuations higher and hence raising returns at each point forward in time as passive share grows, right? It's causing curvature to that system. If I use a linear equation to solve a convex surface, a curved surface, I actually discover that my alphas get pushed negative. They become increasingly negative over time, right? This is just a mathematical operation. This is how we evaluate the performance of active managers. And unfortunately, the underlying data says exactly the same thing, right? The empirical data says we aren't getting more competitive as active managers as fees fall, as the Sharp type framework would suggest. We're actually getting less and less competitive over time.
Mike, I really did not understand the previous thing you said. Can you go back to the previous chart? That went
Sure.
totally went in my head. Yeah.
Okay. So at time zero, right?
Yeah.
Now notice here we've got this curved underlying fund. I should use multiple colors here. It's just laziness on my part. But so here's the underlying return as compared to that flat line, right? So if I go back to remember what we're doing here, right? We have effectively a central return that is mean reverting over time.
Mhm.
If instead it turns out that we have a mean expansionary model, that means that that flat line becomes curved. If I use a linear regression to solve that, at time zero, it's going to give me the same answer I had before. At time one, now I have a system that is upward sloping. And by definition, my intercept has been pushed lower. By the time I get out to time two, I've got negative alphas, right? Those intercepts are just my alphas. So
Mhm.
it makes active managers look worse and worse and worse as compared to a Sharp type theory, which is as fees have fallen, active managers should be looking better and better and better. Right.
Yeah.
So we've actually seen a system that no matter what the response function from active managers is, it just gets worse for them. And unfortunately, this is exactly what we've seen in the empirical data. Right. So here's my theoretical model, and here's the actual empirical data.
Wow. They look pretty correlated. Okay, so some of that I still don't understand, but I'm sure I'll, if I rewatch this, I'll get this, and obviously the audience can rewatch that. But that was
I wish it was more. I wish it was complex, and I could turn around and say like, "Oh no, don't worry, I can walk you through the calculus of it." Like this literally is the y equals mx plus b equation of your sophomore year in high school,
mhm.
right? That's what alpha actually is the intercept in that equation. All you're doing is just saying the return of my portfolio, or pure CAPM model, the return of my portfolio is equal to the beta of the portfolio times the market return, plus this idiosyncratic alpha, which is that endogenous return to the portfolio regardless of market conditions.
But why can't the active investors increase their beta, or increase as it goes up?
That's exactly what we see, right? So what we've seen is hedge fund managers who used to run market neutral now run 85% correlated to the S&P 500.
Mm-hmm.
Right? We've seen markets take more and more and more risk, even as the perception is that markets have gotten less risky, right? So we're losing the actual mechanisms that are meant to underpin the market and prevent market crashes. Short sellers, for example, right? We're seeing the lowest levels of short interest in history. And yet, despite those incredibly low levels of short interest, we saw all hell break loose in the hedge fund space on a rotation out of the FANGs and into, or the MAG 7, I guess we call it today, into the Russell 2000 on a short covering type framework, right? This is, again, despite the fact that we have among the lowest levels of short interest in history, right? So what we've really done is we've taken a market that is designed to function as a capital asset pricing model, and we've turned it into a mechanism that feels very safe, but is ultimately dominated by unintended speculation by index investors.
I think there's a video that I shared on Twitter, and I think you liked it. I don't know if you ended up watching it, but I'll include it in the links. It was about and I knew you would be, you would really eat that stuff up, as well as a lot of our audience, that the index construction of the Canadian stock market during the late 90s, tech bubble and particularly the telecom bubble. And it was something like 30% or over 35% of the Canadian index was just one company, Nortel Networks. And
Yep.
they had a lot of issues. And I think, all of the issues that the stock market has, thank God that the Magnificent Seven company, with one example, in my opinion, that people might guess at, are actually high quality real companies that probably will continue to have a bright future. Maybe some are a little overvalued. But, I think these companies, if all of them were Nortel Networks, or if the market was just in one name that was, either a fraud or was going to go down 80%, I think the market would have much bigger issues than it has. Not to say that the market doesn't have issues, but
it goes quite a bit deeper than that. I'll give a really simple example. In the United States, if I look at the construction of a target date fund, about 30% of the allocation in a target date fund model is going to be to international stocks, right? So you'll have, give or take, 70% domestic, 30% international. If you're an international investor who's trying out this newfangled and increasingly mandated passive investing, you're actually going to be pushed to do the reverse and put about 70% of your assets into, really about 50% of your assets into the United States, right? Because what we've seen is the market capitalization of US equities grow relative to the rest of the world. That means that if you're allocating on a market cap weighted basis, which is what they're supposed to be doing, they're buying more and more of the US, right? And we in the United States convince ourselves that there's a narrative associated with it, right? In the same way that we managed to convince ourselves for thousands of years that the reason the sun goes across the sky is a very handsome young god who drives a golden chariot right across the sky and occasionally irresponsibly hands it off to his bastard son, right? We actually have managed to convince ourselves that it's because we have the best companies, right? We have the most wonderful businesses around the world, right? And we've created a sense of entitlement in our system that says, well, this will always be the case. Forgetting, of course, that the exact opposite was true from give or take 2003 until roughly 2012. What changed? Well, what actually changed was in 2012, target date funds became the default investment for 401ks.
Yes, fortune is fickle, fashion is fickle, and emerging market stocks were all the rage in the early 2000s and the 1990s, and now it's been all about the US. I do think like over the US profit margins and profit growth and revenue growth, I think I would be shocked if it wasn't higher in the US over the past decade than in Europe. But I totally buy that that's the fundamental case. And then there's the kicker, the leverage on top of that is the flows faction. But I don't know if I would necessarily agree that it's the fundamentals argument is equivalent to thinking that, the sun is carried around by a.
Well, let's be really clear on this though. There's also a Soros type reflexivity to it, right? So what in part contributes to the extraordinary profitability of companies like Google, Microsoft, Nvidia, et cetera? Do they pay market wages on a cash basis to their employees? Not really. They actually subsidize their employees through the issuance of new shares.
Yes, yeah.
Right? That in turn actually generates cash flow because what they're really doing is they're selling shares to the public. Which part of the public? Well, this is another fascinating paper that's actually not even released yet that was given to me for comment by the professor, Marco Salmon, at Harvard, who is about to publish this. They've actually done some preprint presentations on it. And it asks the question, who buys who sells when passive buys? And the answer is companies through insiders, right? So what you're actually doing with the growth of passive is in part subsidizing the employment capability and the wage costs and the cash flow generation for Microsoft, Apple, Nvidia, et cetera, right? That in turn resources these companies in a manner that they're able to profit dramatically better than the rest of their peers, right? So it is a feedback loop that is increasingly distorting even the fundamentals themselves.
That's such a fascinating point. I think you're definitely, you nailed it. That as the stock market goes up, that the stock is a currency that is very valuable that can be used to pay employees, the value of it, as well as the perceived value. Oh, and Nvidia stock it's more valuable than gold. Pre-split, I actually think Nvidia stock is more valuable than an ounce of gold. But
why would post-split change it?
Because you get more shares.
You're just saying the price. Okay.
Yeah, just the price, Mike. So long term, you think the bubble will continue, but this little hiccup that we're having, markets down 6%. Jim Cramer, who I actually really like, by the way, he is very worried, and he's like screaming on the opening morning. I think people are probably more freaked out than they would be during a normal 6% correction. Maybe it's because we've had so few deep corrections over the past year.
I don't think that's actually the case. I think
Okay.
there's two separate components to it. One is that we actually know that this is fake, right? That's one of the reasons why people are so nervous about this. People have embraced it and they're more than happy to make money with it. But at the end of the day, there's actually a deep dissatisfaction with a world of pure speculation. Right? There's a second component to it, which is as a society, we've never been more dependent upon the value of those assets.
Yeah.
Right. So we are terrified that the facade will break, right? That we're ultimately forced into a situation in which prices revert to what they would have been historically, because then we can't afford our retirement.
Yes, and also sort of your contrarian take is you have a negative take, but you actually think it will continue with bubble. My version is actually the fiscal irresponsibility of the U.S. government is backed by asset values. So the higher the stock market goes, that can be used for taxes. The higher profits go, that can be used for taxes. However, if if the market isn't strong and the profit growth starts to slow, that is where I get concerned.
Yeah, I mean, I think that you've organized it backwards, but I'm sympathetic to that, right? I think that the increasing reliance on market signals to tell you how the economy is doing has contributed to the belief that the U.S. government doesn't need to behave in a responsible fashion, that there are no consequences associated with it. And so, again, for me, it really boils down to, I think that we have created a system that is ultimately designed to send improper signals to us in the same way that we've done with things like student loans, for example, right? We've stripped the market of its ability to signal the value of a college education. In the absence of supports for student debt, you would see a very different price for going to get a degree in French medieval literature than you would get for going to get a engineering degree from MIT, right? It would be priced radically differently. We stripped the system of those signals. Passive has done something very similar here, where it's stripped the market from its ability to send information signals to us. It's converted leading indicators that incorporate expectations of mean reversion and paths reverting back down, or profitability reverting back down in the future, with systems that are simply projecting whatever explains the current level of pricing.
Right. I think you're totally right that the market is not perfectly rational, and that the market can get ahead of itself to the upside and to the downside. And I think most people probably agree with you and me that the market, I mean, it's only the eggheads at the finance schools that think that it's perfectly rational. But and I think you totally nailed how it is irrational. But I might say there was no golden age, like, of perfect. Where was the golden age? 2006, 2007, when high yield credit spreads were at 250 basis points, and in 2007, a year before the biggest recession since the 1920s, 1999. Like, there's always irrationality, and the structure of it changes. But I think you've perfectly nailed out how this right now the market is irrational. But Mike, just going back to my question about short term, how violent do you think this so far mild 6% pullback is going to be? And can you also draw on your background in volatility, where the market's gone down a lot today and went down a lot yesterday? Is there a phenomenon of volatility where volatility targeting funds get uncomfortable and they have to de-risk and de-gross as the volatility is more than they were expecting?
The great irony is that we continually put up disclaimers that say past performance is no guarantee of future results, and yet we increasingly rely on that underlying framework, right? So I do want to be really, really clear. Like, the question about what happens from here is a function of something that has never occurred before, which is a larger and larger fraction of investors investing passively and suddenly forced to confront the reality that they may be required to de-risk their portfolios relative to what their models had suggested, right? I think we're still very early in that process, but I would highlight that having deviated from those models to participate in the FOMO of, oh, it's all about technology or AI, whatever, it's going to be easier for them to deviate into the, oh my gosh, just get me into a money market fund, right? I just want to be safe. The second thing that I would highlight is this is the first time that we're watching a system that has become the world's largest sovereign wealth fund that by and large behaves as if it is a single entity, right? So remember, things like 401ks and IRAs are creatures of the 1970s. The IRA was introduced to accommodate layoffs in the 1971 recession associated with union workers who had defined benefit plans. They'd get laid off, they'd receive a settlement of their pension plan, and that would be taxed at 75% because it would suddenly show up as a huge slug of income. Right? The IRA was designed to protect and facilitate those rollovers. 401ks were a subchapter of the ERISA Act that identified that this could be offered by employers in a defined contribution plan for workers as compared to the defined benefit plans that had dominated up to that point. Going into the 1981 bull, the bear market and then bull market associated with the aftermath of that, the total size of these two programs was about $150 billion. Today, they're somewhere in the neighborhood of a combined value of about $24 trillion. These are by far the largest wealth platforms in the entire world. And they're increasingly managed as if they are a single portfolio tied largely to momentum factors in US equity markets. Right? That is a very scary situation.
The AI already runs the financial system. In other words, the rules-based AI, it's been running it for years.
It's a rules-based system with intelligence that is largely built on the idea that the future will behave very much like the past, even as we change the behavior of the participants in that system. That's a flawed model.
Mike, what do you think this market's going to do as we may already be in a recession, enter a recession, or, as you said earlier, and the market's down a little bit? What are your what's your view for the short term?
Well, my general sense is, unfortunately, that I wish I could definitively say this is going to go one direction or another. It is very dependent. I think one of the risks is that the Federal Reserve is operating under a framework that says, well, everything was totally fine, and now the market in one form or another is trying to push us to behave. Right? They have anthropomorphized the market in the same way we do, right? We have to figure out, what can we do to get the Fed to respond, right? What does this actually mean? What is the market pricing in? The simple reality is when you introduce rules-based systems, it's not doing anything other than pricing the rules. And so that's really what is underway. Now, if the Federal Reserve wakes up to that and says, oh my gosh, the entire system could break and we have to respond to it, then we'll have a different answer. My gut tells me that the Fed is going to try to stay very tough, right? They're going to try to say, you can't scare us or force us into stuff until, of course, we get to the point that they are sufficiently scared, and then they will panic, as they did in the fourth quarter of 2018, as they did around COVID, as they did around the interest rate hikes in 2022. This is not a Fed that is disciplined or principled on the basis of a theoretical belief structure. They're just increasingly locked into a reactionary mode in which they say, how do we solve the existing problem today? And again, that's not a good system.
Yeah, exactly, Mike. And as we started recording, the market was pricing a chance of a double cut, a 50 basis point cut in September, their next meeting. Now the market is pricing in an 80% chance of that cut and a chance that they might even do 4 cuts in total by November. So a double cut followed by a double cut, a 50% chance of that by November. The market's down 2.3%. If the current regime we've been in of people think there's a recession, but there actually isn't, that pricing is way off. It seems a little extreme to me of a double cut and then a double cut. What are you thinking right now about the rates market, Mike? As someone who, I believe in your ETF, FIG, you trade everything, right? Stocks as well as interest rates stuff.
I mean, I manage a couple of funds. I highlight FIG because that's the one that most closely represents what I can do with absolute discretion. It's also been very frustrating, candidly. And so I've been wrong both about interest rate policy as well as about the market's ability to price in what I think is an emergent credit cycle that's going to be quite severe. So my expectation is that the market is ahead of what the Fed is ultimately going to do. But that just means it can get worse rather than getting better, right? If we can't force the Fed, quote unquote, we can't force the Fed to cut 4 times by the end of the year, then the market will continue to try, right? I think we're kind of at that point. You mentioned the S&P down 2%. The Russell 2000 is down roughly 4 right now, right? This was the segment of the market that as recently as a week ago, people were arguing that its positive performance was indicative that the economy was soft landed and that it was expanding. And I was sitting there saying, that's absurd. Now, of course, the market is moving that direction. It just becomes a question of how much remains to unwind from that. And that is really the point that I just want to emphasize for people, which is when you talk about flows and you talk about the impact of them and the multiplier, we haven't even begun to see meaningful outflows yet, right? So we've continued to see inflows into Vanguard funds. You've continued to see inflows into BlackRock funds on the equity and bond side. There is no sign of panic yet, even though markets are suddenly pricing as if there is. So right. If that panic really shows up, I think we could see a truly momentous event.
Not momentous compared to 2020, but still momentous.
I don't know why you say that.
Half as momentous as 2020 is still plenty momentous enough for me.
I mean, that might be plenty momentous for you. I'm not convinced that in any way that defines a limit.
Mm-hmm. Yeah. Well, markets are definitely not. They do not have a normal distribution. They're not a bell curve.
Yeah, I mean, I could walk you through. I could walk your audience, your poor suffering audience, through any number of charts that shows how that distribution has actually become corrupted over the past couple of years. The evidence is actually that we have an increasingly negative skew in the market, even as we completely failed to price that in. So ultimately, I think we've been led astray by the behavior of markets, and suddenly people are waking up and saying, oh my gosh, how could I possibly have known the economy was slowing? I was told that we had 7% deficits and therefore we could never have a recession or negative employment, et cetera. Candidly, those are crap. And we'll find out what the real story is as we play through this. But just remember that no matter how bad it gets in markets, at the end of the day, they are telling you fake information in both directions as long as these remain the dominant features of a market.
How bad do you think it's going to get? Another question might be, what is it going to take for you to turn foaming at the mouth bullish? How much do stocks have to decline? How much, do credit spreads have to blow out where you actually think now is the time to go long? Because as you know, the bottom of the market cycle is often well before the bottom of the economic cycle.
Oh, I think that's absolutely true. And I would remind you, I know that in March, April of 2020, I was foaming at the mouth bullish and screaming for people saying, wait a second, do you understand what just transpired here? This is not the liquidation cycle. This is actually a re-equitization cycle in which the government pumped extraordinary amounts of stimulus into the system and further underpin the growth of both speculation and passive investing. That's on record for interviews that I did around that time period. Now we're in the opposite situation. And so the question really boils down to, what is the response function? If the US government steps in with another $2.5 or $4 trillion worth of stimulus, that will obviously underpin a response, not a healthy one, and one that validates many of the concerns of money printer goes burr type frameworks. But you have to keep that in consideration. It's the exact same behavior that's occurred on the opposite side of the equation, where people have been panicking and saying, oh my gosh, nobody will ever buy bonds again, right? Why would you ever want to buy a bond? Well, today is exactly why you want to buy a bond. But part of the reason that we saw that behavior is those fixed allocation portfolios in the presence of an increase in issuance. If I'm only going to buy X quantity of bonds and the government increases issuance, regardless of what the level of yields are, right? I'm not going to change my allocations. Who's going to buy the bonds becomes the right question. Once the panic sets in, the answer is everybody. Once yields get cut to the point that you can finance those bonds, an entirely new class of levered investors starts to step in, right? So the point of panic is to take advantage of other people's panic. That can occur in both the top side, which has been a frustrating experience for those who have been more skeptical of the underlying data. And now it's creating opportunity on the other side. But we're a long way away from the point at which I would argue that there is an empirical support for companies on a continuous basis.
Yes, and a 10-year at 2% might be more attractive to a leveraged investor when the interest rates are at 0%. Than a 10-year at 5% when the overnight rate's at 5.5%. Mike, thanks so much for coming on, sharing your time and insights. People could find you on Twitter at Prof Plum. Your Substack is Yes, I Give a Fig. And what is it, simplify.com? They can find Simplify.us. Simplify.us. Mike, thanks so much. Final question is, have you been paying any attention? Do you have any thoughts on the enormous amount of money, of cash, that is being funneled into the asset class known as private credit? Ares just raised $15 billion in equity. The total vehicle, including leverage, will be something like $33 billion. And I tweeted, and I could be wrong about this, this is not something you see right before a credit crunch. It might be something you see 2 years before a credit crunch. But I'm seeing this cash being raised. The people who are running the fund don't get paid unless they pile it into very risky loans with high spreads. That seems like that could stave off a credit event for some time now. What do you think about that?
So I think the scale is very small relative to the scale of the issues that we face in credit. One, recognize that the funding of private credit is not actually traditional funding. So when you raise $15 billion, it's not like that money has actually been contributed in advance. Those are actually commitments from institutional investors that will require them to sell other assets. The second is that there is very much a wealth transfer component that is underway, where private equity is being slammed with much higher than anticipated financing costs. And as I pointed out before, the IPO market is closed. That means it's increasingly difficult for them to generate liquidity. Private credit will likely be a beneficiary of those components, but it really boils down to, are they actually able to allocate that capital? The exact same observation as you made, that these are things that don't happen. Remember, in 2006 and 2007, you saw record levels of funds raised to invest in distressed debt, that you saw record levels of funds raised to invest in private equity. And in many situations, the investors were very poorly positioned to meet those obligations. That's why you saw secondary sales and interest, where entities like Harvard, for example, dumped their private equity positions at 8 cents on the dollar. Right. Wow. So, I'm never scared of the idea of dry powder on the sidelines, particularly when it is a very weak sauce version of dry powder in the form of commitments as compared to actual funded cash positions.
Very interesting. Mike, thanks again. Thanks everyone for watching.
Thank you. Take care.
Thanks for watching. Remember to check out vaneck.com/moatfg to learn more about the VanEck Morningstar Wide Moat ETF, ticker MOAT. Lastly, Forward Guidance is available not just on YouTube, but on all podcast apps, and a video version is available on Spotify and Twitter, where I post interviews regularly. Thanks again. Until next time.